everyone, I'm Brian DiMarco. I'm here with my colleague Matt Gordon. Today we're here to talk about gross profit margin. So Matt, what is gross profit margin?
So gross profit margin is going to be our gross profit expressed as a percentage of income. Now what's gross profit? Gross profit is going to be our revenue plus our cost of goods sold, right? So what's our cost of goods sold in a pest control company? That's going to be our materials, our technician labor, our auto costs. So we're going to take our income, less those costs, and that will lead us to our gross profit. Now, we want to express that as a percentage of income, right? So as an example, let's just say we have $100 worth of income, $50 of that, it costs us to produce that revenue. That would be a gross profit of 50%.
Okay, understood. That's very helpful. So if I'm looking at, what's happening on the road and getting to my gross profit margin, what are some of the costs that are not included?
Yes, so this is a very common question I get from our clients. So what's not included in our gross profit percentage is going to be our salespeople, our CSRs, our rent, our utilities. Any costs that aren't necessarily related to production would not be included in that gross profit percentage.
Gotcha. So, and why is this margin specifically so important?
So this margin is important because it tells us how much money is going to be left over after we perform our production to pay off those other costs that we need to run our business. So for example, let's say our gross profit margin is 55%. For every dollar's worth of production we do, we're going to have 55 cents left to cover that rent, our sales people, all that other stuff.
Okay, and what's good margin that I should aim for?
So on average, we like to see 50 to 55%. However, best-in-class companies are running at 60% and higher.
All right, it's very helpful. Yeah.